So welcome everyone. Welcome to this Market Thursday, August 12th. It's 6 p.m. here in London. Last time we did one was start of July, I think. I've been pretty lazy, so I went on holiday for a couple of weeks, and before that, one of my daughters got COVID, so I was a bit unlucky staying at home, and it was a bit hard for me to do the trading and doing the webinar in the meantime. So that is why I have not been doing much since early July. As a quick disclaimer, those webinars, and this one is just for investment, is not an investment advice. So this is purely for information. As a quick disclaimer, I do not take responsibility for losses incurred by viewers. So please do your own research. I hope that those webinars have been helping you over the last 12-18 months. My intention is still to carry on doing them. So thank you for those who are joining today and those of you who are watching later on YouTube. So let's discuss today what we're going to be looking at. So quickly, my background, I started to work in the industry as a trader in Paris in 2000. I started in Paris. I worked for 4 years for an asset manager. Then I joined the hedge fund in London in 2004, where we had both a long-only product and a long-short product, where we were managing overall as a company between 2 to 3 billion. Trillion is a bit too much, billion, where the Western European part where I was working was managing between $500 million to $1 billion. In 2008, I started to do prop trading. I worked briefly for 6 months for Madoff. Then I joined Griffin Capital, not Griffin, Infinity for from 2009 to 2018. I took a long sabbatical of 2 to 3 years, and I rejoined at the start of this year. And as well, since 2014, I've been mentoring people from all over the world, retail traders, for another company that I left in 2018, and I launched my own mentoring program, my video series in 2019. So this is for my background. So what are we going to be covering today? As usual, situation across asset classes, stocks, credit, commodities, FX, market review, recent performances, looking at the summer. Then we're going to be doing a quick macro review, looking at the world PMIs, the job market, and a bit of inflation with the CPI that came out yesterday. Then we're going to be looking backwards of how has been the Q2 2021 earnings season, how good it was versus history. Then a bit of more, I always try to look about, catalyst, price action, macro, looking at drivers, and in the meantime, trying to help people who want to join, who would like to join in the industry. So today I'll be covering 3 different jobs as a trader, which in reality are very different. So I want to make sure that people understand what we are mentioning. Then finally, we're going to be talking about maybe doing a bit of Q&A session. So as I said again, last webinar was 6 weeks ago. Yesterday we had the US CPI. The US job report, the NFP report on Friday was very strong. As always, I'm looking at the next catalyst. So summer is always, is most of the time very quiet, unless you have been in 2015, where at the end of August, the market moved a lot. But normally it's very quiet. If you look at the volume on the S&P, if you take the ETF SPY, so I checked just before the call. Since last Thursday, we have been trading below 50 million shares, which is like volumes that we're going to have between Christmas and the New Year. So the market is very quiet, but still slowly but surely grinding. So there is a risk on still going on. In terms of catalysts going forward, as you know, and as I've been mentioning many times, the market is more and more driven by options. So we need to be always knowing when are the OPEX, meaning when are the option expiring. So next week on Wednesday, we're going to have the VIX expiry. And then the Friday after the option expiry. So if there is a chance of a bit of a turn, that might be around this Wednesday and Friday. What has been happening over the last 2 to 3 months is actually the market is kind of reacting before the expiry. So there is instead, before that we used to have moves after the expiry because the market makers were readjusting their delta gamma hedging. Now it feels like the market is is forecasting a bit in advance. Everyone is a bit boring. Next catalyst from the 26th to the 28th, we get the Jackson Hole meeting where the Fed is going to sit, and maybe we're going to have more color about the tapering. If you remember last year, that was the time when the Fed announced that they will give them a bit more flexibility with their dual mandate, especially on the inflation part, saying that the 2% will be adjusted and 2% should be seen as an average, which actually was a good way for them to say over the last 3 months and probably over the next 3 to 6 months, we are okay to have the inflation running hot, and we're not going to be necessarily increasing rates and tapering too quickly. So those are the catalysts then with back to school season coming. We're going to have some, hopefully the volume picking up and action coming up back again in September. Same with the ECB, that should adjust with their talking. There is one concern, obviously, which has been around for ages, which is the COVID. So the variant, I think the market is fine with the variant in developed market. As long as you get vaccinated, the chances of you getting hospitalized are very low. It's more an issue, as we're going to see, for emerging market. What I'm reading from here is, you know, as long as the US schools are going to be open, the market seems to be fine. Let's move on the price action now. As always, looking at the asset class year to date. So the first part here is all about stocks. What is interesting is developed market have been doing very well based on the vaccines. And the parts that are doing not as well is emerging market / Asia, putting aside India. So India is doing fine. Today it was making new highs. Yeah, today it made new highs. But it has been a market for developed market doing pretty well. Any versus the emerging market that have been struggling. So as I said at the start of the year, when I looked at the 2021 expectation, I was a bit more cautious on emerging market based on the potential strength of the dollar, the level of debts, and as well the gap or the mismatch in terms of timing between the access for developed market to vaccines and much more time expected or time decay for emerging market. Then FX, so that this is this part. So the dollar has been strengthening quite a lot. We are at almost 117 on the euro dollar. So there was a lot of talk similar at the start of the year that, you know, the dollar will be weakening. This is, you know, this is the end of the king dollar. I told you before, I was a bit more cautious. I think that the carry trade was not that obvious, that there is no real alternative so far for the dollar. And in terms of price action, nothing was really saying that the dollar should be weakening like there is no tomorrow. So always with FX, sorry to tell you that, because my background is stocks mainly, but FX, there is a lot of noise. If you talk macro, you're going to sound very smart, But reality, if you look at the trading range or the moves that we had in FX over the last 12 months, it's between top 5 to 10%. That is nothing to do with the other asset classes. So pretty boring for FX. Bitcoin that has been bouncing from the 30,000 level. That's it. Gold pretty weak, so we're going to be checking that later. And WTI that I mentioned last webinar, which actually I traded badly, and I'm going to explain a bit more to you what I did. Week to date, so over the last 5 days, 5 days where the market is, as I said, slowly grinding 1%. So it's like, it feels like 1 to 2% for stocks every month. The risk that you have when the market is grinding slowly in low volume, you go up, then there is a bump. So always hard to time. Otherwise, Bitcoin back to its volatility. Next one, S&P sector performances year to date and week to date. Interestingly, energy and financials are doing pretty well, 32% for each of them, roughly. Financials have been doing very well over the last week. And if you look at the XLF, it's making new highs. So there is always a case for the financials that now these share buyback programs are now kicking in. So that is helping the overall sector. At the other end of the spectrum, we get utilities, consumer staples, which have been underperforming the market. Utilities, for those of you who will be watching through the ETF, where the ticker is XLU, I think there is an interesting setup now. We are close to the breakout level. So this is one of the sector that I'm closely monitoring. But overall, as you can see, this is a risk-on market where the S&P is up 19% roughly. And actually the NASDAQ IT is doing not as good as the overall market. Not a big difference, but normally the driver of this market has been over the last 5 years, IT, NASDAQ. Same thing if we look at the US industry performances. So if you know me, if you've been following what I've been doing, I always start with the top, which is the indexes, then I go into the sectors, then I go into the industries. For the industries, you get tons of ETF that are provided. And what we can see here, this is on a monthly variation. Steel, home builders, materials have been doing very well. Why? Because they just signed in the US the Biden or the infrastructure bill, which finally we started to talk about it 9 months ago. It took quite a long time. It's much smaller than expected, but at least this is signed. I think now a lot has been priced in, so I'll be cautious on all those names that have been pushed higher. So this is for the 5 days, 1 month, 3 months, year to date. On the other end of the spectrum, oil, silver. So there has been a sell-off in oil and gold, especially on Monday, where the market was actually, so the sell-off happened mostly overnight. So if you always look at the calendar, what is interesting is Japan was closed on Monday. So it happened in a very illiquid market. Where this illiquid market, when you get a liquid market, you get stops that will be run, especially here, where you get a lot of retail traders that are putting orders in the market. So when it goes, and as it happened overnight between Sunday to Monday, the gold really suffer. Let's carry on, if I manage to do it, up. Other asset classes, looking at the bonds. So the bonds yields have been going up. So the US 10 years went from 115, 120 to 135, 140. So this is the week to date level. We are up on the year. So we were coming from very high yield level or high yield, I don't know if that's the terms, but we're coming from 170, 180. Then the bonds, we had a rally in bonds, meaning yields came down massively. We went to the 115. So there has been different talks on lower inflation expectations, on some bad positioning. I think there was probably some very bad positioning which extended the move. But across the overall bond market, yields have been coming down quite a lot from the February, March level. In terms of VIX, so the VIX is at 16%. So that's something that I always talk about, which is the rule of 16%, which equals to an S&P move of 1% on the day. So interestingly, if you look at the realized volatility of the S&P, if you look at the moves that we had over the last 10 days, volume and price action, we could expect, or you could have expect, lower implied volatility, but you need to take into account that the S&P is made of 500 stocks, and out of these 500 stocks, there are tons of stocks that potentially could be moving and are completely dislocated by the number of calls, options that have been trading. That is true for Moderna that went from 250 to 500. But you have some names that are distorting this implied volatility. Plus, as always, people are playing the outlier, expecting an abnormal move. In terms of top winners and top losers, again, we are in the middle, not in the middle, we are at the end now of the earnings season, because roughly 90% of stocks of companies have been coming with their earnings. But overall, this is the stocks that have been moving the most are either stocks like biotech that are coming with good or negative news, or earnings. Let's go now into price action. So this one is a stock that I'm looking in Europe for a special situation, but let's look at start with volatility that I just mentioned, 1560 on the VIX. So again, 16%. So this is the bottom that we have these days. You can make sure that if the market stays boring over the next couple of weeks or 3, we're going to be testing the lows, the 13%. S&P, let's go from the top up. S&P, so the S&P, the trend is still the same. You are grinding, you are above the 50-day moving average. There is from time to time a 1, 2, 3% hiccup, but not much happening. So as long as we are holding this level, as long as you consolidate above those levels, the trend is still higher. If you look at the Nasdaq, is there is less visibility on the there is less momentum on the Nasdaq. Okay, so clearly, market participants are on one hand confident of the US economy, and on the other hand, what about inflation and what about the yields effect on this Nasdaq? So we have been making new highs, but it's not as a market leader as it used to be. Russell, so the Russell mid caps, small mid caps, same consolidating since March. We discussed that many times. It had a very good run after the election and on the COVID, but has been consolidating based on dodgy names like GME. What is the other name? Some 2 or 3 names that have been coming down now. So it's really driven by those option-driven shit names. Sorry for my English, but that is what has been happening with the Russell. So here we are in the middle of the range. We're going to do a bit of Europe because we trade Europe as well. So this is the stock 600. As you can see, the trend is, my friend, you are middle of the range. I think today we had the 9th session in a row where the stock 600 is up on the day. So there is a non-stop up market, not big moves, but up every day. Inflows with inflows with inflows. XLU that I've mentioned before. So XLU breaking out. So you should, this chart is a bit misleading because it's not taking into account dividends. But I think this is an interesting one for a potential breakout. Quickly, materials, which has been on the tier over the last 5 days with the stimulus, fiscal stimulus. I still don't like the chart. I think the chart is telling me for the time being that either we consolidate or we go down from here. So for the timing, nothing really excited. And as we discussed a bit before, for the market driver, the XLF, which stands for the financial, so actually breaking out, making new highs, many names. If you do breakout analysis, you will see that many names over the last 5 days have been breaking out. So very interesting setup. A lot of insurance stocks, small, mid, big caps have been moving higher, AIG and some other names. US 10 years, let's move into the bonds. We're not going to be taking too much time, but quickly to give you, again, we don't do technical analysis on yields, but that's to give us a bit of picture. So we went from the 90 bips to the 1.8%, came back at 115, and now we are hovering around the 135, 140%. The market has not made up its mind about and around the inflation that we're going to be discussing just after. 10 years versus the 2, there has been a bit of flattening of the yield curve. So for those of you who have access to TradingView, get an account on TradingView, look at the 10 versus the 2. I would like to talk about the euro dollar, a bit of FX, because I know that most of you first start with FX, then realize that, oh, what about I start to make money? And when I start to be doing something else than FX. So picture on the euro dollar, as I said before, again and again at 122, 123, I think, you know, the long-term trend is now dollar negative, but I think we will be retesting this 113, 114. There were too many market participants wrongly positioned and have been suffering. So for the time being, I don't think that the dollar will be weakening that much. And as always with FX, there is a good chance that I might be wrong. Quickly, oil, that's minor and not Colgate, so we're going to be taking the 2. So I mentioned during the last webinar that I wanted to go short, and I was short actually. Oil around 74, 75. I managed to, how do you say that in English, to fuck that up. Why? Because I think it's not that I think I had 2 stop losses that were too tight. So I had a very good entry price. I managed to miss that one. So early July, which was a bit painful, kind of destroyed the momentum when you start the month and you don't have much P&L. So bottom line is, I think the oil is still the same. There was confirmation today that both the IEA and OPEC reduced their expectations in terms of demand in 2022. So the only reason we get oil at 75, 76 was because, you know, OPEC is reducing production. But clearly we started to see at the start of July that there was some, let's say, misunderstanding or a bit of a fight between between the different players among OPEC, at least two of them. So as long as we are not going to see a pickup in real demand, if you think about the 100 million supply or demand that we had before COVID, for the time being, we are probably 3 to 5% below this level. So between 95 and 97 million barrels. So that means there is no reason to squeeze the oil that much higher. A bit of retail trader, gold futures. So gold futures, as I said, were destroyed on Monday. So this is the big candle that we had here, the big candle, a bit of a bounce, which actually, if you think about it, really tested the 1680. As very often when we had a sell-off, it will retest those lows. The chart is not looking great. I've been saying that for the last 3 to 6 months, so I've been on record. I'm not a big fan. I think this is one of the misleading, the errors that many retail traders do during the first 5-10 years of their trading, is they read the doom and gloom. So they do mostly for gold, and then they do really badly by trading with huge leverage in FX. So be careful. If you put some gold, that should be only part of your allocation. But the price action is still not looking great. What about we move back to the slides here, looking, if I manage to do it again. Okay, let's move now into the central bank's balance sheet. So that's something that we should always keep in mind. The ECB, so in Europe, and the Fed in the US are still increasing the size of the balance sheet. So the Fed balance sheet now stands at 8.23 trillion as of last Thursday. So above this 8 trillion level, this is the same for the ECB, above 8 trillion euro. And in other words, that means since February 2020, the Fed increased and doubled the size of its balance sheet. So doubled the size of its balance sheet by 4 billion. And you can see that the trend is still the same. Okay, so based on that, you still have a lot of liquidity, a lot of easing from those several central banks. As long as there is no tapering, there is no, unless obviously you get an external event, you know, there is a good chance. 4 billion or 4 trillion? No, this is 4 trillion, Youssef. So we went from 4 trillion to 8 trillion now. I don't know if I say billion or trillion, but that will be trillion, which will be the size of those balance sheets. So very significant. If you put everything into perspective, the US GDP is every year, or used to be before crisis, around 20 trillion. So 8 trillion represent 40% of the US GDP. So check the central bank's balance sheet. For those of you who have access to the 4x4 video series as well, checking from time to time Money2, M2, M1, and see months on months how these M2 levels have been doing. Actually, there was an interesting data from China, which has been reducing a bit the loan, as we've been saying before, and the M2 level recently. Next, going into macro, we're going to do, as always, a quick overall view of the macro. So looking at the manufacturing PMIs, so PMIs, Purchasing Manager Index, where we look at this leading indicator for those US, China, Eurozone, Japan, and overall the global and emerging market, which is something that are built as proprietary data. As you can see, the blue and the gray here are outperforming And so that's the 23-25% of the US GDP and the 15% plus of the Eurozone, which are outperforming the rest of the world for the time being. And on the other end of the spectrum, China is doing a bit not great. Emerging market, which 50-60% is going to be China, is around the 50-51. Again, there is a gap between emerging and developed market, which explain as well the price action that we've seen over the last 6 months. As the world has been reopening, as the developed market has been reopening, that makes this difference. I think what is interesting from the last couple of weeks is actually China seems to be closing a bit. So I read today that one of their big port in China, the third in the world, has been closing. So if you think about the supply chain and the issues that we had through the PMIs, that we've seen through the PMIs around the supply chain and getting the products from Asia, that could be another problem in the next couple of months or 3 months with chips, with cars. So that could create another tension. So that's something to monitor going forward. But overall, for developed market, PMIs have been extremely strong, manufacturing PMI, and the PMI services in the US printing 64%, I think, as well, has been very, very strong. And if you look at all the sectors of the manufacturing PMIs, the overall picture is more or less the same, meaning the cyclicals are very strong. So same picture it was months ago, couple of months ago, 3 months ago, a very strong number, inflation coming down a bit, but still elevated. Next one. So this is the picture that I'm using for market. You can go on market website and you can see, as we discussed before, the difference between developed market and emerging market. So emerging market has been slowing to actually a bit of a recession for Asia. So we see like China is flattish, Indonesia was at 42%, so pretty bad. So there is a difference. Normally, those are you will see in a normal world, the opposite, where emerging markets are really outperforming developed market. US job market. So as I mentioned at the start of this call, we had the NFP numbers on Friday. So job market and the NFP are lagging indicator. Having said that, it's interesting to look at it to understand how many jobs we still need to create for the Fed to be less accommodative. If you think about what the Fed has been saying over the last 12 months is, we don't look that much at inflation because we know that inflation could overshoot, but we are looking at the job market. And we want the job market to come back to where it was pre-crisis, which was 3.5%. So 3.5% unemployment. Last Friday report, we had a 5.4 unemployment report. So that means a gap of, let's say, 2%. But you need as well to add the labor force participation rate, which is at 61.7% these days and used to be at 63.3%. So to make it short, the difference in jobs between now and 18 months ago is roughly 6 million jobs. So depending if we create 800 to 900,000 jobs every month, like last month, I think is not going to happen. But let's say we create between on average 300 to 500,000 jobs every month. If you want to reduce these 6 million, you're going to have probably another 12 to 18 months. 12 to 18 months for the unemployment rate to go back to 3.5%. 18 months from now means end of 2022, start of 2023. And guess what? This is more or less when the market is pricing the Fed to hike rates again. So you don't need to be a genius. Again, pretty easy to understand. Those things you can do it, just you need to have those spreadsheets. US inflation CPI. So we got the CPI yesterday. With the core inflation, so here I'm always looking at the core CPI. The rest is a lot of noise. Fed is looking at the PCE, but the core CPI year on year is obviously overshooting based on the reopening of the world and on the base effect. But actually the month on month is coming down, but still above the, let's say, 0.1, 0.2% that we should have month on month. So there have been some factors before that have been creating this overshooting, but look, I'm not a macro genius, but it feels like it has been spreading across the different components of inflation. So there is inflation in this system, not as big as it used to be a couple of months ago, but it's still way above this 2% inflation level. So there is a question mark now. I think it's a 50-50 or let's say 70-30 to see if it's going to be transitory or not. Earnings season, at the end of the day, the market goes up or down on earnings. Okay, this is earnings plus the multiplier. We know that the multiplier. So if we look at PE, when we said that the market is trading, let's say on 25 times, we'll be looking at the multiplier, which is conditional of, how cheap the money is based on central banks. And secondly, the earnings growth. So the earnings growth have been pretty strong. I'm interested of what happened in Q2 2021. So I use FactSet. It's pretty nice. It's pretty clear. So here we can see the picture. From what they have been saying, 87% of the companies beat the expectation, 87%, which is way above the 75% level. You can see by sector who has been doing well and which sector has been doing a bit less. So interestingly, consumer staples and utilities that we discussed before that were underperforming the market, guess what? They have not been beating the market as much, the expectation as much as the other sectors. So there is always, or there is very often a reason when things are outperforming or underperforming. Similarly, if you go into the next slide, in terms of revenues, the revenues, same 87% beat on the revenues. So 87% on the revenues and on the EPS. So that is a very, very, very strong bit. We had a very strong earnings in the earnings season in the US. So here, this is from Bloomberg, which is more or less the same picture. You can see where we had the bit in terms of sales. So energy, I think the expectations were pretty low. And in terms of earnings, where we had a lot of sectors which beat the expectation by 10% or more for the earnings. And if we look now at the Stock 600, when we look at the chart, we've seen that Stock 600 is on a tear. In terms of earnings, beat have been pretty significant. That is a bit less true in terms of sales. Question mark here for Europe. There has been beat. The beat are probably around 70-80%, which is less than the US, but still above average. What about we look at job in trading? So today I want to be discussing 3 jobs in trading. The first one is execution trader, second one is sales trader, and the third one is proprietary trader. I have many young male adults most of the time who come to me and say, look, Greg, I'm interested in working in the industry. I'm interested in working in trading. And actually, they'll be confusing the different jobs that are based on trading. So the first thing that we should be looking at is to understand the difference between the sell side and the buy side in trading. So the sell side is about creating, promoting, and selling traded securities. So that will be the banks, the brokers selling stocks, that will be the different brokers that will call these institutions to be buying or selling stocks. And on the other hand, you get the buy side, where that will be the institutions, the BlackRock of this world, the proprietary trading company, the hedge fund, that buy securities for money management purpose. So that is very important to understand first, where would you like to be? Would you like to be on the buy side, on the sales, or on the sell side? There are positives and negatives. I'm not taking any judgment saying, you know, one is better than the other. Actually, I think one is better than the other because I've been spending the last 20 years on the buy side. But, you know, why not working on the sell side? So first thing is the execution trader. So execution trader is on the buy side, and there is as well some execution trader on the sell side. But most of the time, what an execution trader will do is he will work for a hedge fund or an asset manager and will be executing order for the portfolio or the asset manager. So in other words, if you're working as a portfolio manager or hedge fund manager for a big hedge fund, you will have a portfolio and limits, but you will not necessarily be executing on your own the orders. So you will be using the execution order. So imagine that you want to be buying 50 billion worth of Microsoft. You'll say to your execution trader, okay, buy me 50 billion worth of Microsoft. You will decide if that's on a limit, if that's on the day, if that's on average, and the execution trader will purely execute the order on the market. So in other words, the execution trader does not take the decision if he wants to go long, short, or exposure that he wants to take. So this job is not P&L dependent, where your pay is going to be mainly as a fixed salary. Obviously, if the hedge fund, if the overall structure is doing well, and if this execution trader is executing the trade in a good way, he will have a bonus. So there are some positives and negatives. One of the negatives is intellectually, I don't think this is very compelling. It's mostly about execution. But this job needs a lot of skills. That is not that easy to be executing, 20 trades at the same time on 4 asset classes. So that needs skills. That is very true for those execution traders that are working for big hedge funds, where they are adding value and where they try, for instance, to beat the VWAP. So the VWAP is the volume weighted average price. So if you take over the last hour, one stock has been trading on average based on the volume around 99. Okay. If as an execution trader, you can be buying the stock on average at 98.8 for your portfolio manager, you are really adding value. One of the downside that we have seen over the years is obviously this job of execution trader has been, let's say, destroyed or reduced by algos. So algos are taking the jobs of those execution traders. Still, my conviction is, if you need to do big orders, if you get big book, those guys doing execution trader, you have some very good guys that have the skills to do it. So there is a good article on eFinancials, but don't look at the execution. When people are telling you, oh, I'm working as a trader for a hedge fund, that means most of the time they're going to be execution trader and they are not taking any position. And really, they are executing the order. So here, and for the next 2 ones, just to give you an example, so that I wanted to put some role that were offered. So I took this from a job offer on Bloomberg, sorry, where I'm explaining what you'll have to do, what will be your skills. So literally execution trader, where you need to understand how the market works, the drivers, you need to do a lot of coding. But clearly this is only about about executing the trade. So you're not going to take any decision. It's just the PM, the portfolio manager, the hedge fund manager, and the long only asset manager will tell you, okay, buy this, do that, but you're not going to be taking the final decision. You don't need necessarily a lot of experience. Having said that, the big hedge funds will have very experienced execution trader. Again, those guys are really, really good. And as always, they're asking for passionate coding and blah, blah. Next one is the sales trader. So here I got two stories about sales trading, which is from my experience over the last 20 years. So first one is in 2000, at the end of my curriculum for the business school, I had to do an internship. So I was unlucky to do an internship for three months for internship helping sales trader. So literally salespeople that were as well executing orders. And in 2020 years ago, I realized that I never wanted to do this job. Why? Because those guys are were just there to be making money based on commissions. They didn't know what was a position, long, short. When they were asking me, for instance, to put like a DCF model, instead of telling me, build your DCF model and comes and tell me what your price will be, they will tell me, I want the DCF model to end up with a 100 euro, let's say, target price. So I really didn't like that space, didn't like the human being. It's all about the commissions. So it's like any salespeople, not very different from selling cars or selling anything else. My second experience was more recently in 2014. This one is a funny one. So in 2014, when I joined the other education company that I used to work for, the person asked me to join him on I think it was on a Thursday, to a presentation he was making in London. And for me, it was all about discovering retail traders and how retail traders were looking for information. So the presentation was all about saying, meet this trader, a very successful trader, and you're going to learn a lot from it. So I was sitting in this London University in the back, and after 2 minutes, this person started to say, okay, so when you want to buy or sell something, you need to be very convinced. So he was saying, when you call your clients, you have in less than 1 minute to convince him to be buying or selling the stock. And I sat there and I was like, as a trader, having clients, you don't have any clients. So I knew at that time that instead of being a prop trader or a trader, this person was a sales trader. That doesn't mean that this is bad, but that means this is not pure trading. When you do sales trading, you work on the sales side. So you buy and sell stocks on behalf of their clients, of your clients, and you need to be a good salesperson. So most of your job will be going early in most of the time the banks or the brokers, looking at the morning meeting, talking about the ideas that were pushed on that would be pushed on the day, long and short, sending the research, and at 8 in the morning in the UK, 9 in Paris, 9:30 in New York, you'll be calling your client and say, oh, today we got a strong conviction that you should be buying X and selling Y, and you get 1 minute, but you don't take position. So you're not a trader. Most of the business is in reality divided into two things. First thing is the proprietary trading, which actually makes a very small part of the business, less than 10%. And most of the business is about the market making. So the client will call you, take the position, and very quickly 90% of the position will be flipped in the market. Plus, with what happened over the last 10 years with regulation, sales traders are doing mostly sales and very little trading, meaning that most of you, even if the term is about sales trading, most of your P&L is coming from commissions. And obviously, what happened over the last 20 years is it get killed by the direct market access for most market participants. So if I give you an example, if we come back to my experience in 2000, those sales traders were charging on any single trade 20 bips or 0.2% of the trade. So let's say you are executing €1 million order for a client, they will be taking €2,000. And these days, if I use DMA, the way I do it at Infinity, with direct access to the market, I will be paying less than 1 bip. So let's say 0.5 bips. So that means sales traders, by definition, have been killed by this direct market access to the market. And there is less and less commission. So banks are less and less keen on taking risk and took very little risk. So that means the job of sales trader is mainly about selling things. That doesn't mean that this is a bad thing, but if you think about, entering a bank and saying, oh, I'm going to be a sales trader and I'm going to be a trader, like a prop trader taking position, this is not true. You are mostly selling things. So be cautious, be careful on where you want to go, and be cautious on what actually people are telling you what they've done in the past. So sales trader here, this is an example. I took this example from LinkedIn. And as you can see, this is mostly about, institutional clients focus on sales of European equity derivatives. So this is mostly about the relationship with your clients. Again, if you are working as a hedge fund manager, if you are working as a prop trader, you don't have any clients in the same way. You will have clients if you're a hedge fund, but the clients are more, they subscribe to your product, but you don't call them every morning to say, oh, you should be buying this or selling this. So this is why we come into the next phase of this presentation, which is proprietary trader. So I've been a proprietary trader since 2008. So this is a pure buy-side job where the bank, long time ago, and now mostly the proprietary trading firm, use their own capital to trade. That is true as well for family office. There is a lot of family offices that are now doing the same things like it used to be for Madoff, for instance, because there is less regulation. As I just said, it's different from the hedge fund, as there is no client, there is no NAV, there is no redemptions. So the salary is going to be small at Infinity is at 0, and it's all about trading P&L. So how much can you be making from your P&L, and you're going to be getting a cut out of your P&L. And the most important things as a prop trader will be your track record and your risk management. And you'll be allocated a trading book, so meaning exactly the way we do things as retail traders, and all my subscribers and all my mentees are doing. I do have exactly the same mandate, which is managing my own money. I'm managing someone else's money, but I'm doing the same. So you're going to have limits, you're going to have value at risk, you're going to have hard stop loss, you're going to have a mandate based on which asset classes you can trade, the regions, the strategy. There's no clients, there's no commissions. Okay, so the story about commission is gone. And it's all about absolute returns. So you need to be making money to get some payout. And there is no watermark. So it doesn't matter if the S&P is up 30% or down 30%, all about the P&L. So again, my mandate, the prop trader mandate, is similar to retail traders. This business of prop trading has been impacted by the Volcker rule just after the great financial crisis, which prohibited banks and institutions that own the bank from prop trading. So in reality, many banks played around the rules and still managed to have prop trading, but officially there was not. And very often prop traders in bank that was true 20 years ago and still true now, will be flow traders, or they will be doing mostly market making. So when you get the flow, I have experience of people that were trading with me, people coming from big institutions like Goldman Sachs. They were used of trading the flow from the bank. And then when they end up with a real prop book, that was a different story. That doesn't mean that they are not good at what they are doing. Actually, they are successful at what they are doing, the same way as sales traders are good at what they are doing, or the execution trader. But this is a very different job than the prop trader. So if you are looking for a job here, what you will need is the most important thing. So the same, it's coming from Goldman Sachs, from Bloomberg, where they clearly tell you need to have a strong track record. So here, this is a bit specific. This is for energy trader, but what matters is really having a good track record. So each time someone comes to me and say, look, Greg, how can I become a prop trader? Yes, you need the track record. Some others will say, oh, what about I do the CFA? I think CFA helps if you want to have access to hedge funds and you need to be putting on your CV CFA and they want to be raising money. But for pure prop trading, I don't think CFA helps that much. So what you need to do when you're looking for a job in trading, first, understanding if it's in the buy side or the sell side. One is no better than the other. They're just very different, meaning, do you have clients or no clients? If you get clients, you get a sales trader. Is it going to be execution? Is it going to be sales trading? Is it going to be prop? Are you going to have a fixed salary versus a variable salary? This is a very different dynamics. Trust me, I've been doing both. Having a salary before at the hedge fund, no salary in prop trading, and that makes your trading very, very different. Are you going to be regulated or non-regulated? And why is it important? Because if you are regulated, that means you don't have access to necessarily the same strategies, but as well, you will have to pass exams. So recently, lucky enough, I managed to place one of my mentees with one hedge fund, and he recently told me that he had to pass the IMC, which is entry level of exam to get access and to be able to execute orders. And question mark as well is, if you're looking for a job, what kind of skills are needed? If you are looking to be an execution trader, you need to be good with the different algos, executing orders with several, maybe Bloomberg, maybe Reuters, maybe another software. Do you need Excel? Do you need to be good at macro? What the experience that is needed? If you are an execution trader, you need less experience and you don't need a track record like you will need if you are a prop trader. If you are a sales trader, you need to come with clients. So you need to have a coverage of clients and to be able to move your clients from one place to another. So question mark, what is the track record versus your client's portfolio? What do you want to trade? What is your knowledge? What is your expertise? If you are in Europe, you're much better at covering European assets than you will be covering US assets. So we get a question mark of assets and regions. So this is it for the 3 different jobs. Be careful what you'll be targeting. If you get questions, I'm always open. So please send me an email. If I can help you, maybe I can help you. Who knows? If you get question, please feel free to send me an email. Quickly going through what I can offer, where I can help you. Education. So there are 3 parts in my education. There's a trading community. I'm pushing hard. I have some good people now pushing the story a bit more. So every week now, people are coming with long and short ideas. So that is a good thing. I'm very thankful. Let's carry on doing this job. So if you do the mentoring or if you do the 4x4 video series, you will get access to this community. traders. For the time being, we are between 70 and 100 active users. Next one is the 4x4 video series that I launched in October 2019, based on my previous experience as a mentor, knowing what people were missing, struggling, misleading, and as well based on my 20 years experience as a prop trader, hedge fund manager, long-only product. So you're gonna have access to 40 videos. It's roughly 30 hours of footage, 50 Excel spreadsheet that I update every month. That works very well. So I want to believe it works pretty well. And you can have access either for 2 months or 12 months. And finally, the mentoring program. So the mentoring program is for more advanced traders, portfolio managers. This is a 12 weekly one-on-one online sessions that we do on Zoom or Skype, where we look at your infrastructure. We look at the quantitative analysis, qualitative analysis, price action, risk management, options. We do a lot. It's very intensive, meaning that if you can't be putting 20 hours plus of work between, or let's say 20 hours, 10, 20 hours of work between sessions, you're not going to get the most out of it. So that works well. I really enjoy it. I'm very dedicated to that. Okay, this is it. Maybe some questions, looking quickly. Jaime, how do you demonstrate track record without industry experience and only having traded as retail trader? I know that you're using Interactive Broker. So actually Interactive Broker is seen as, and some other brokers, as long as your book is not too small, for companies like Infinity, they will be looking at your track record from places like Interactive Broker, as long as they can see that you can scale the strategy and that your risk management is good. So that is possible. I'm not saying that this is easy. You need probably 18, 24 months of track record and finding the connection to enter this world. I know that in New York, they have been working with that platform for traders, and they might be enrolling traders that are successful. So probably it for today, because I've been talking for an hour, so time to go. Thank you for joining. If you have questions on macro, price action, different jobs, please feel free to send me an email. Thank you for watching today. Thank you for watching on YouTube. If you like it, please comment and put some likes, because that gives some traction, and that might help people to get some education. So again, thank you for joining, and talk to you in probably 2 weeks. Bye-bye, everyone.